So I often get this question: how does installment debt or installment credit versus revolving credit impact my credit score? Let's talk about it. Well, first, we need to try to understand what installment debt is versus what revolving debt is. Okay, so installment debt is pretty much a debt that doesn't, well, the minimum payment doesn't change on a month-to-month basis, right? And a great example of installment debt would be like a mortgage, right? Whatever the monthly payment is, that's what the monthly payment is going to be. Of course, unless you refinance or, your rate change for whatever the reason is. But typically, you have a 30-year fix of rate, right? So a mortgage monthly payment would be considered an installment debt or auto loan, right? If you bought a car, most likely at the initial sign up, whatever the monthly payment that you was told, that's what it's going to be until you possibly finish paying for that car, right? Personal loan is a form of installment debt, right? Student loan is another form of installment debt, okay? So, well, how does installment debt impact your credit? Well, if you haven't seen this video, I've recorded a video previously where I talked about the five category of what the FICO algorithm uses to calculate your credit score. I went into great detail in that video in regards to those five categories. So if you haven't seen it, I would definitely encourage you to go ahead and go back and watch that video. But how does installment debt impact your credit score? Well, it impacted in a great deal, right? Because it falls under that number one category, which is the payment history category, right? Make sure you make your payments on time, not only on time, but at least pay the minimum payments to kind of help your credit score. So installment debt fall under the payment history, the credit history category, and that category is account for 35% of your credit score, which you can actually gain 192.5 points on that particular category. So that's a lot of points. That's almost 200 points. So as you can see how installment debt can impact your credit score. So if you capitalize on that particular category and you make sure your payments has been taken care of, so installment debt will fall under that category. Okay, so let's move on to revolving debt. Now, revolving debt is a little more trickier, right? Installment debt is a straightforward, but revolving debt is a little more trickier. Revolving debt. So what is revolving debt? Okay, revolving debt is really the opposite of installment debt. It's a debt that you can continuously repeatedly use without having to, run your credit again, right? Meaning a hard pull. So installment debt fall under the second highest category, right? Which is the utilization category, right? Again, if you haven't seen the five category where I break down the five category of what the algorithm uses to calculate your score, please go back and do so. And you probably could see it somewhere on the upper right-hand corner. So revolving debt, an example of revolving debt is like a credit card, right? So let's just say you have a limit of $5,000 on that credit card, right? Well, how much of that $5,000 do you actually use on a month-to-month basis, right? The monthly payment will change from month to month based on how much you use from that limit. That's the difference between installment. Installment, the minimum payment doesn't change. Usually it stays exactly as it always has been. But installment debt, based on how much you use on that credit card, revolving debt, based on how much you use on that particular credit card, on that particular limit that you was given, then the monthly payment subject to change from month to month. So that's what make it revolving, right? And it fall under the utilization category. Okay, so the thing about revolving debt is that it impacts two of the category, which is the payment history okay, which is the highest category, account for 35% of your score. You can earn 192.5 points in that category. And then the utilization category, the second highest category, where you can earn 165 points on that category and account for 30% of your credit score. So the revolving debt itself, it impacts both of those categories. So at the very least, most folks will tell you, well, you want to use no more than 30% of that revolving debt, right? Meaning the 30% of that credit limit that you is given. I beg different on that particular aspect. Over all my years in the credit industry, lower than 7% is the best place you want to be at the closing billing cycle, right? The 30% doesn't hurt you by any means, right? But you don't want to go over that 30%. It tell a different story in your credit report. So when future lender check your credit report, that's the very first thing they do. And the credit score itself is the second thing they actually check, right? So you don't want to go over 30%. It kind of tells the story as you need your credit card to live versus you just using it because you want to. And that's the story you want to tell. I'm using it because I want to, not because I have to. Okay, so you want to try to keep them under 7% to maximum on the 165 points for the utilization category, right? So I hope I was able to get those two explanation across to you a way that you can actually understand it. I tend to speak a little fast, so I welcome any comment. So if that is indeed the case, please write me a comment, good or bad. I welcome all. Let me know how I could do better next time. But if you can help to push this video, a simple like gesture will help other people. The algorithm will do wonder to help other people to find the content just as you was able to find it. But also, if you like more videos such as this one, please consider subscribe. Not only that, it would definitely help, grow the channel as well. So I appreciate your time. Thank you for listening.